FY27 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Venkatesh Krishnan, MD and CEO, Spandana Sphoorty Financial, for his opening remarks. Thank you, and over to you, sir.
Good morning, all. Thanks for joining this Q1 FY27 call. This is the first time we are holding the call in the morning, so we can safely say Spandana ki nai subah hai and ummeedon bhari subah hai. A few quantitative and qualitative aspects before I hand over the mic to my colleague CFO Ashish Damani. It was a good quarter that went by on multiple fronts. Our AUM grew 11% quarter on quarter to 4,887 crores. New member addition was at 55% as compared to 40% rather in the March quarter. Overall member count also increased to 1.38 lakh during the quarter as compared to 1.1 odd lakhs in the March quarter. Collection efficiency, which is a ex-bucket collection efficiency, which is a very important parameter, was at 99.5% as anticipated. Annualized credit cost at 2.1% was against 3.2% in the March quarter. We managed to collect 51 crores in the 90 plus pool. The marginal cost of funding came down to 11.3% as against 12% last quarter. And we managed to garner around 500 crores of sanction under the credit guarantee scheme. And sanctions are still coming, and there are quite a few sanctions in the pipeline as well. Overall cost of borrowing came down to 12.8% as against 13.2%, with the bank share going up from 44% to 47%. The new share of portfolio, which is sourcing effective 1st of April 2025, grew to 91%. And of course, the most important thing is that PAT was 12 crores as against 5 crores in the March 26 quarter. Sufficient liquidity and capital adequacy are areas wherein at this point in time we are holding good. On the qualitative front, we realized that the top 5 states contribute about 60% of our total share, which is Madhya Pradesh, Bihar, Andhra, Telangana, Odisha, and West Bengal. 2 states we really want to grow in the coming quarters are Tamil Nadu, where our share currently is just about 15 crores out of the industry of 38,000 crores. And Maharashtra, where we are at about 288 crores as against the industry of 24,000 crores. So 1.1% share, we want to to 2% share. Individual loan product is ready to be piloted in 8 branches in Madhya Pradesh. So we are putting about 8-10 people. Over the next 3 months, we want to test it out because this is a completely different product, better underwritten with e-NASH facility. We want to just check the initial what is the acceptability. Of course, this is going to be for existing customers to begin with. But in the days to come, we will migrate to new to Spandana customers as well, anyone who's got a track record elsewhere. Like in any other business, you will always have many of the branches doing well and a few branches not doing well. We also realized that we carved out 100 branches there where there was scope for improvement, either on the business or collections or both. And we're trying to get a separate team to revive this because merger or closure in microfinance rarely leads to success. So we said that this time around we are going to revive these branches, and we are quite hopeful these 100 branches can really turn out to be significant contributors in the times to come. El Nino, much spoken about. What's going to happen, time alone will say, but proactively, the credit and a strategy, how to deal with new customers who are not exposed to any form of credit, who are staying in a rented premise, so on and so forth. So we put some game plan for select districts. It's likely to be impacted. So it's a wait and watch with adequate controls. The balance rights issue money of 200 crores, 100 crores from the promoter and the balance 100 crores from others who participated is expected this quarter, before the end of this quarter. We have a new Chief Business Officer for South. That position was vacant for a couple of months, has recently joined us. Who's going to take care of Andhra, Telangana, Tamil Nadu, Karnataka and Kerala. Comes with a lot of experience. So with that, we have all the complements of the 4 Chief Business Officers, North, South, East, West. State heads are there. So overall, business is looking good, but that does not should not lead to complacency. So we're putting our head down to ensure that we stay focused on basics. And the basic is how we are able to collect on the due date, how we are following up on the 1 to 90 bucket. The 90 plus pool is a large pool for us, so ensuring that we keep collecting as much as possible. This is the last year we're going to focus on this so-called 90 plus book, because after that, we don't expect customers who are 2 years or more thereafter paying us. And then, of course, focusing on productivity and disbursals. So all in all, we seem to be on the right direction, keeping fingers crossed for the coming quarters. But at this point in time, we are happy with how the revised Spandana is shaping up. With that, I hand it over to Ashish, my colleague.
Thanks, Venki. Good morning, everybody. Thank you for joining in this call. I'll like to cover some of the highlights on the financial side, starting with business drivers. Our AUM stood at 4,887 crores with 11% quarter-on-quarter growth. So this is 12% was the last quarter. This quarter it's 11%. We just hope that the disbursement trend continues. We will be able to sustain the growth rate for coming quarters as well. New book, which we have originated under the new SRO guidelines or credit rules that we have put up, stands at 91%. Again, this is getting better with every quarter passing by. Hopefully, this should move to 95% or so in the coming quarter. The way portfolio quality has been shaping up as the ex-bucket collection efficiency sustains at 99.5% or above, which is what we were expecting it to be, it has a positive bearing on all the quality parameters. So if you look at 1 to 90, it has come down to 1.2% against 1.3% of the AUM last quarter. GNPA stood at 3.6%, again improved from 3.8 what we have seen in March quarter. Consolidated NPA accordingly was at 0.68 against the 0.73 for March. We continue to hold a reasonable amount of or a good amount of provisioning on the NPA. It stood at over 80%. Improvement in business has led to improvement also on the borrowing side. If you see, we had been able to raise 1,597 crores in the first quarter, and it has come at a favorable pricing when compared to the last quarter at 11.3, almost 70 basis points lower than what we have seen in Q4. Even on the liquidity side, we continue to maintain strong liquidity at 1,316 crores as of June end. Some of the financial performance highlights. Portfolio I have covered at 91%, drives the net CE also to 99.4%. This is in the new book, so stood very strong. Portfolio quality and AUM mix is helping us, to see register improvement in the yield. So yield accordingly has moved to 24.6%, up from 22.8% in quarter 4. So marginal cost of borrowings I have covered earlier, but 120 bips was the decline in the cost of borrowing, marginal cost of borrowings, and we hope, like Venki explained, that there was a lot of sanctions that we have received in CGS and we are likely to receive more, should help us continue to see some improvement in the marginal cost of borrowings. With the improving trend in the yield and declining borrowing cost, our NIM improved to 12.5% compared to 9.9% in the previous quarter. PPOP accordingly was at 16 crores without the recoveries. With recoveries, it was at 40 crores, and I think the improvement is clearly visible. Accordingly, the PAT has also seen improvement at 12 crores compared to 5 crores, which was reported for the quarter 4. I will stop here and maybe open the floor for questions and take it from there.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Harshit Khadka with Robo Capital. Please go ahead.
Hi, thank you for the opportunity. So earlier we had said that we are comfortable with 2.5 to 3% credit cost. So are we still maintaining that target for FY27?
Very much. We are at, as I said, 2.1% for Q1, and efforts are on to retain that.
Okay, sir, understood. And what is our ROA target for FY27 and 28?
See, the ROA should be looked at in a BAU. So 28, we expect it to, go to the business as usual, and our stated position is, 3.5% kind of a ROA is something that should be feasible in the kind of, ROA tree that we have. The current ROA is at 1%. This should, improve from here is the expectation for FY27.
Okay, sir, understood. Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question comes from the line of Karthik Srinivas with Unify Mutual Fund. Please go ahead.
Thank you, sir, and congratulations on a good set of numbers. So I just wanted to understand on the liquidity part. We have maintained at about 1,300 crores, which is slightly above our BAU, if I'll have to put it that way, because last year was a little bit of a slowdown, and then we had to maintain liquidity. So I just wanted to understand how is it going to be going forward? Will we reduce our liquidity and put it into more use in terms of more disbursements, or how are we seeing the quarters to come by, sir?
Hi, Karthik. Thanks for the question. I think the way to look at the liquidity is, yes, we are trying to, ensure that the business disbursements are smooth. And some of it can also always be relating to the timing. Quarter ends, there is a drawdown that happens, and accordingly you may see a slightly higher liquidity. But the point is well taken. As the situation is improving, as the environment is improving, we will like to optimize on the overall liquidity that we will carry in the balance sheet. Having said that, we should always be of the cognizance that in microfinance it's always better to stay liquid than keep gasping for that.
Got it. That's it from my side, sir. Thank you and all the very best.
Thank you.
Participants, please press star and 1 to ask a question. The next question comes from the line of Sajal Raj with Zenflow Finance. Please go ahead.
Good morning, sir. Am I audible?
Yes.
Good morning, sir. So congratulations on the improvement in the rating part. Could you share whether this has already translated into lower cost of borrowing, and if so, by roughly how many basis points? Also, what is your expectation for the cost of borrowing in FY27? Can you provide any broad range?
Hi, Sajal. So I am sure you would have noticed that, the cost of borrowings incremental has already seen improvement. We are at 11.3% against the 12% last quarter. The rating definitely has a role to play, and any improvement there will translate into better pricing for the company. And like we have said, the borrowings under the CGS also is helping us to keep the cost at a lower end of the spectrum, and we hope that this number will sustain, and we may see some more improvement as well. In any case, since the incremental borrowing is going to replace a higher cost of borrowing which we have done in the past, you have seen that translating into benefit on the overall cost of funds as well, which was at 12.8 compared to 13.2, and we should see some further improvement in the coming quarter.
Now, just to add on, performance and ratings are intertwined. And as I said, our bank share has gone up from 44% to 47%, and efforts are on to increase it further. And more importantly, as days pass by, you will have PSU banks participating, which should also bring down the cost of acquisition.
Thank you so much, sir. All the best for the future.
Thank you. The next question comes from the line of Abhijit Tibrewal with Motilal Oswal. Please go ahead.
Yeah, good morning, sir. Thank you for taking my question. Just two things. One is on the liability side. Ashish, sir, you also mentioned that this quarter we are expecting more sanctions under CGS, and to that extent you are expecting the marginal cost of borrowings to trend further lower. But how are things on the other borrowings? Basically, all I'm trying to understand is while we are expecting more PSU banking lines to open up, are we in a situation today where access to liabilities can impede our growth targets this year, the business targets this year?
Hi, Abhijit. Good morning. So, of the 1597 crores that we have drawn, what was drawn under the CGS for the quarter was about 200 crores. The rest is yet to be drawn. That clearly depicts that there is borrowings which is available outside CGS as well. Even in terms of cost of borrowing, we've been able to secure this borrowing at a reasonably good pricing, even outside CGS, I'm saying, and that's how you've seen 11.3% of incremental cost of borrowing on overall borrowings, despite that CGS was only 200 crores out of the 1597.
Got it. And sir, what is the target for business disbursements this year?
So we are looking at anywhere between 6 to 6,500 crores.
Okay.
And just to add on to the liquidity part, even during trying times, institutions were quite supportive of Spandana for a variety of reasons, including the promoter caliber and credibility in the marketplace. Now, more and more players are coming into the fold with whom we are talking. Some of the names, banking names who were not part of the funding thus far are also talking to us. So it's looking good.
Got it, sir. And then, sir, earlier during the call, someone asked you that, what is the guidance or what is the target on credit costs this year? So you had said that stays in that same range, 2.5% to 3%. I'm guessing this is gross credit costs that we're talking about. Then you also said that maybe this is the last year where we'll be pursuing the recoveries. So, if I were to even include recoveries now, what could net credit costs be like this year?
Closer to nil.
Okay, great.
And also read my statement saying when I said this is the last year, of course, there is always going to be a pool of 90. So what I meant was the older 90 plus, we will not collect it, but of course you will have some 90 plus this year also. So those collections will always remain. The older pool will stop starting next year onwards.
Sure, sir. That is well received. And the last question that I now had is on the yield trajectory. We have obviously seen yields improve over the last few quarters, also because maybe the reversals are also lower now. At what point will these yields stabilize?
So our ideal yield at which we disburse is around 25.25%. So accordingly, we are very close to that number, Abhijit. So yield going forward should see some improvement, but then it should sustain from there.
Got it. That's all I had. Thank you so much, and I wish you and your team the very best.
Thank you.
The next question comes from the line of Shripal Doshi with Equirius Capital. Please go ahead.
Hi, sir. Good morning, and thank you for giving me the opportunity. So my first question was on the asset side. Have you taken any rate increase there in the last couple of quarters?
So the last increase that we did was 1st of October 25. After that, there was no rate increase. It's largely the mix changing favorably, which is improving the yield. And like the last participant mentioned that, the reversals because of the N2 90 plus is not as much as what we have seen in previous quarters. The yield kind of, improves because of that as well.
Got it. So
Sorry, Shipal.
There are no further plans to increase the rates at this point in time.
Okay, got it. And so we were in this branch rundown journey. So when do we see that getting concluded? And what is the number that we have in mind to sort of consolidate at?
So I addressed this partly a little while ago. We have 1,250 odd branches, and it will remain so. No further plans to merge down. Of course, a few branches here and there may underperform, and that's why I'm putting up a task force to ensure that these branches are revived rather than shutting it down or merging it. So otherwise, this count of 1,250 will remain. In fact, it might actually go up if you really expand in Tamil Nadu and Maharashtra.
Right. So that is where I was. That is where I was going to ask the next question. That if we aspire to expand there, especially when we've got a new business head also for that. So in that case, do we see branch expansion coming back actually?
Sure. Some branches in Maharashtra and Tamil Nadu for sure this year. And then of the 5 or 6 large states that we have, which I spelled it out, Madhya Pradesh, Bihar, Odisha, Karnataka, West Bengal, and Andhra, Telangana, we will keep seeing, wherever there is potential, we want to grow contiguous. If there are gaps in certain districts, we can always keep growing. But at the same time, we also need to ensure that the existing branches are juiced out.
Got it. So the last question was on the asset quality side. So we are in the last week of the month. How are you seeing the current month collection efficiency? You highlighted about the uncertainties of delayed monsoon or El Nino. But are you seeing any of that playing out in July so far? Or we are broadly intact at what we were for the last quarter?
Thus far, in line with what we have seen in the balance months of this year. But as I said, we have taken certain proactive measures to how we source new customers in certain districts which are likely to be impacted. But thus far, no adverse observation in the collection efficiency.
Got it. So I have more questions. I'll come in the queue. So thank you so much.
Thank you.
The next question comes from the line of Ashlesh Sonje with Kotak Securities. Please go ahead.
Hi team, good morning. A few questions from my side. Firstly, if you can just clarify on whether you are seeing any early signs of elevated bounces or forward flows in your portfolio as thus far in the last few months because of the weak monsoon. So that's the first one. And just to follow up on that one, if the asset quality seems to be holding up fine, if you can also share why is that the case in your view?
So the first point, as I said just before this question, is saying as of now we are not seeing any adversity in the way the portfolio is behaving. So that remains. Why is the portfolio holding up is also depends on how you source customers and what is the kind of discipline that you are trying to inbuilt into your on-time repayment, your meeting centers, your follow-ups, both at 1 to 90 levels and 90 plus. So this is a very simple business wherein you got to keep doing the same thing again and again, day in and day out. There can be some blips here and there depending upon the situation, but large swings will not happen if you have your process and controls in place.
Understood. Okay. Second one was on the recoveries. You have indicated that the net credit cost will turn out to be negligible in this year. If I compare that, so that effectively amounts to, I assume, a recovery of close to about 250, 300 crores, 150 to 200 crores in this year. Correct me if I'm wrong there. How does that compare with the total amount of slippages that you have seen in this cycle? I assume that number would be close to about 2,000 crores plus.
What has happened in the past, if you try and compare, that's why we have this 90 plus pool, which is large enough. Okay, so that should not be a basis for how I look at this year or the years to come through. That pool is large enough, and we are going to collect anywhere between 150 to 200 crores. We are trying to see if we can collect a little more than 200 crores as well. With each passing month, today we are averaging between 16 and 18 crores a month. Aiming for a 20 crore looks a little tough, but you should still put in the efforts to try and see. But flow, as I said, if your flow is manageable, if you are 99.5%, then your flow is marginalized, and even if you are able to collect 50% of the flow, then you are home and dry.
So if I were to ask it differently, the pool which is currently in the written-off zone, you would say that the recovery from there would be largely negligible. Is that fair?
No, we are collecting from that only. 150, 200 crores of collections that we envisage for this year is going to come from the existing 90 plus pool, which is about roughly 2,500 crores, of which we have collected about 300 crores last year. 380?
385 in last 18 months.
385. So that happens. 15, 16 crores is coming from that pool.
Understood. Okay. So, and just lastly, correct me if I'm wrong, if I heard you incorrectly, the CGS MFI scheme, you have raised about 200 crores. If you can share what was the rough pricing on that?
500 crores raised thus far, utilizes 200 crores. Pricing is just about at 10% or little over 10%, because there are sub 10%, there are marginally over 10% as well.
Perfect, sir. Thank you very much. Those are all the questions I had.
Thank you. The next question comes from the line of Meghna Luthra with InCred Equities. Please go ahead.
Yeah, hi. Thank you for the opportunity. So congratulations on a good quarter. I just had two questions. One is there is slight inch up in the new book delinquency. What is the normalized level that we see over there? And secondly, how do we see OPEX moving in this year and the next year?
Delinquency, we are aiming for a 99.5% collection efficiency. Again, if you look at the top 6 states which contribute 60%, Andhra, Telangana was at about 99.2, Bihar was 99.4, Madhya Pradesh and Odisha upwards of 99.5, West Bengal was 99.4. So by and large, we are at that 99.5%. So some delinquencies will happen, but we are able to collect it. But average, what we are aiming for is 99.5, which we are holding on thus far, including this month.
So on the OPEX, sorry, Meghna, you have a follow-up on that?
No, go ahead. Nothing.
Yeah, so on the OPEX, we have seen a good quarter, and we just hoping that, we'll be in the same range in terms of the I think we should be more around 675 crores or so for the full year this year, and next year should be just a 10% increase on that.
That said, we are also looking at some investments. Tamil Nadu, Maharashtra I spoke of. We are also looking at some automation which will help reduce the manual intake. So we are trying to ensure that the savings that come through are plowed back in one form or the other, which is going to really help this company from the times to come.
Got it. Thank you.
The next question comes from the line of Rajiv Mehta with Yes Securities. Please go ahead.
Yeah, hi, good morning. Good numbers. Just one clarification. When you say 90 plus recoveries are, kind of 51 crore in the quarter, this is NPLs plus write-off pool recoveries, right?
That's right.
Okay. And out of which 24 crore was the write-off pool recovery, and then the remaining should be the NPL recoveries number. Yeah, and this number of 51 crore, you are saying you're targeting it to be around 150-200 odd crore for the whole year.
Yes.
Understood. And see, just on credit cost, while the flows have significantly come down, your X bucket is also now 99.5. So from a flow point of view and from existing, coverage on stage 2 and stage 3 point of view, and even from write-off point of view, I mean, the credit cost seems to be moving favorably. One thing, when I look at your coverage on stage 1, it is only 40 basis points. And when I look around peers, they are either at, 1% or even higher than 1%. So is there a thought that at some point in time, maybe not this year, maybe next year, you would want to, take it up to where the industry is operating at?
Very much. It's a very valid observation. We are working on it. But unlike many of the other players in the industry, our frontline officers also focus on 90 plus because of the sheer size.
Right.
Of course, there is only so much a frontline officer can do when he has to disburse X bucket 1 to 90 and 90 plus. But yes, the focus is on to raise at least the bar to 50% in the 1 to 30 segment.
Okay. And, some thoughts, did you share, you've shared the disbursement number, but are you sharing it for end March 2027 and end March 28?
This year, we are aiming for about exit of about anywhere little upwards of 6,000 crores. March 28 may turn out to be a guidance which we will plan as we get into August, September times. But broadly, we are looking at 10,000 crores or nearabouts by March 28.
And just from a cost point of view, see, one is rationalization. I think that is an exercise we have done. But from a productivity point of view of your OPEX or of your loan officers, what is the plan to raise it so that they go to the optimal number of customer per loan officer? See, one is on the acquisition side, but what all can drive better acquisition of customer and maybe so that productivity of resources can help us leverage the OPEX the way we are conceiving right now.
So two aspects. One, of course, is acquisition of new members, which I spoke of last quarter was 55%, which is very important from a growth trajectory. Second is retention of your good customers. So there we are trying to ensure that the good customers who've been with us, and of course also good with other players in the industry, we don't lose.
Got it. Thanks so much, and best of luck.
A reminder to all participants, please press star and 1 to ask a question. The next question comes from the line of Amay Chetta with Banyan Capital. Please go.
Thanks for the opportunity. So all my questions have been answered. Just one clarification. This ROA of 3.5% was for FY28, right? Next year.
That's right.
That's right.
And what would be this number this year?
Like I've said, we are presently at 1%, and we should see some more improvement in this number going forward for the current year.
Okay. Thank you so much.
Thank you. Participants, please press star and 1 to ask a question. The next question comes from the line of Sukrit Patil with Eyesight FinTrade. Please go ahead.
Good morning, team. I have two questions. My first question to Mr. Venkatesh is, beyond the regular outlook, what are the top 2-3 execution priorities you are focusing on in the next few quarters? And alongside that, what do you see as the biggest risk in borrower demand or competitive pressures, and how are you preparing to manage them while strengthening the company's position in microfinance and small lending? That's my first question. I'll ask my second question after this. Thank you.
So priorities, as I said, we're just about ready with our individual loan product, and we're going to be piloting it in 8 branches of Madhya Pradesh. We want to make it a success and roll it pan-India and for our group company, Chris Financial as well. That's a new initiative, which is, I'm very hopeful that it may not be a huge share, but definitely a much better underwritten offering. Point number 2, definitely we have 6 states wherein we are at about 65%, but as I said, Tamil Nadu and Maharashtra, why we have not really grown these 2 states hitherto is something which I wish to now grow and make it as big as any of the other states like a Bihar or a Madhya Pradesh. So that is another priority we are working on. Third, which is very important for us to ensure that we are able to work on the attrition front and ensure that we retain people, because over time we realize that once the people are there on board, their productivity improves, reliability improves. Point number 4, we are working on a new LOS platform, which should be in the UAT stage by the end of this quarter, and October to December we are going to be migrating, which is the Perfior's platform from JAM. That's a big initiative for the company, migrating 1,250 branches. That also has its own inbuilt credit platform, collections platform, that will lead to a lot of insights into how we approach customers, how we record the customer observations, skip trace of customer mobile numbers, so on and so forth. So these are the 3-4 priorities I'm working on. And then, of course, as we go along in this journey, depending upon how things are happening, we can do more initiatives.
Thank you. My second question to Mr. Damani is, again, along the similar line. From a financial point of view, what key risks or challenges do you anticipate in the coming quarters, and what specific measures are being taken to manage margin, cash flow, and balance sheet strength, especially in areas like credit risk, repayment cycles, or regulatory compliance? Thank
you. So the way we look at it is, yes, credit cost is something that will be on the top of mind. We have strengthened our underwriting substantially over the course of last 15 months or so, and we ensuring that we stay put with that. It has yielded good results. We hope that it could continue to stay that way. So that's the important aspect. We have controlled our operating cost, and we are very focused on that front. The growth that we are going to get is with very limited or no investments on increasing the cost side from a cost side. So that's another important aspect that we're looking at. Our financial borrowing cost got elevated during the stress period. The focus is how do we bring that cost down and protect the NIMs as we progress. So these are the aspects which we've been focusing on, and I think so far we have had a reasonable amount of success, and hopefully will continue to sustain all the success that we've got.
Thank you, and best wishes.
Thank you.
Thank you.
Participants, please press star and 1 to ask a question. The next question comes from the line of Prabal Gandhi with InCred AMC. Please go ahead.
Hi, am I audible?
Yeah, hi Prabal. You are audible.
Hi sir, thank you for the opportunity. So just one question. From 2013 onwards, we have seen this 3-4 times now that in an upcycle we scale up to 8,000, 10,000 crores of AUM. And then as the down cycle starts, versus our peers, our consolidation is heavier. So in this cycle, how are you ensuring that here on, even if the cycle downturns in 1.5, 2 years, at least we'll be able to sustain our AUM, and therefore there is some assurance on sustainability of numbers on the beyond near term as well.
So point number 1, there is no problem in growth, but it has to be sustainable growth, and you need to have adequate controls and process. There are only three things in this industry one needs to take care of. One is your process and controls. Ad nauseum, I'm going to keep talking about this. Second is point number 2 is discipline, and third is calibrated growth. If you wish to grow at 100% and your systems don't support, you're going to fall. So we are ensuring that we grow reasonably. At the same time, all the building blocks that are in place in terms of ensuring that the growth is adequately supported by controls, especially focus on recoveries, so that, as you rightly said, if at all there is a sort of a downturn or some swings in the marketplace, we are in sync with the market and don't go below that.
Okay, and any example of discipline or practices that you can highlight which gives you confidence that this time underwriting will be more prudent compared to previous upcycles?
So one of the questions, of course, not asked, let me answer, that will be quite relevant to what asked. The SROs are really playing a big role in ensuring that the industry really grows and the confidence in the industry also grows. So today, as I talk to you, Spandana plus 3 is at about 3.7% only, which used to be about 20-25%. So 98% of the customers that I added were regular, and we were the only borrowers at that point in time when we gave the loan. So the market has now come to realize that we got to ensure that the credit parameters are adhered to without any miss. Otherwise, it not only impacts you, but it impacts other players as well. So we are ensuring that whatever guardrails are there, the guardrails are adhered to. As I said, we have also taken cognizance of the fact that there could be an El Nino. So how do we handle new to credit customers? The family has both spouse being new to credit, staying in a rented apartment or a rented house, how to deal with them. We are also ensuring that the telecalling is something that we are able to reach out to our customers. So, for instance, what came as a sort of a realization to me is in my telecalling outfit, we are able to receive 30-odd lakh rupees from customers directly online through the QR code that we generate when we are calling the delinquent customers. So we are trying to see whether we can increase that 30 lakhs to 50 lakhs to begin with. Then we realized that there are agencies who are doing bot calling. So we have hired the services of bot calling, which is also increasing our reach to customers, because the bots can call you repeatedly without really talking about 80 connects a day or so on and so forth. Second, we are also ensuring that the product offerings that we have, take a relook in terms of the ticket size, how we are treating customers who've been with us for 4-5 cycles. Are we allowing those customers to go to competition, or we are able to retain them and we are able to see performance? So these are 3 or 4 things we are doing, coupled with the initiatives of the SRO to ensure that we run a predictable franchise.
Understood. And just last question, how is Kedara looking at the performance of the senior management team? Is it more about scaling of the business? Is it more about profitability? How is the incentive being derived for the senior management team by Kedara?
So if your question is aimed at saying that how long will Kedara stay invested, no answers, but at least I see them here for at least next 2-3 years. Now, whether Kedara stays or does not stay, we need to perform. And if you are able to perform, everyone is wanting to have a share of Spandana. That apart, Kedara has been very, very supportive. No interference. We just have a monthly reviews wherein they come and check with us what exactly is happening, any help items. If there are any AI initiatives, since they have that skill and expertise, they are willing to help us on AI-led initiatives. So other than that, they have been very supportive and listening to what or rather helping us deliver on the dotted lines.
Actually, it was more on the lines of how is Kedara reviewing the performance of the senior management team, as you mentioned that it's a 2 to 3 year timeline for them. So are they looking more from the perspective of how quickly can we scale our AUM, or they are more focused on profitability or asset quality? Any particular metrics that they are more prioritizing compared to other metrics in the evaluation of the senior management team?
We are deciding that. Kedara has no role to play. what to grow, which markets to grow, how to grow, what are the things we need to do, which are the areas we need to automate. Everything is done by the management.
Understood. Thank you, sir. All the best.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management for the closing remarks.
Thanks once again for joining the Q1 FY27 call. I'm sure all of us are relatively happy with the performance, and efforts are on to ensure that we replicate this, put our heads down, and do our basics right. No heroics. That's about it from my side.
Thank you, sir. Ladies and gentlemen, on behalf of Spandana Sphoorty Financial Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.